Hello, I'm Amber Kanwar. Welcome to Market Call. For the next hour, we have David Burrows on the show, President and Chief Investment Strategist at Barometer Capital Management. He'll be taking your calls, emails, tweets, and those video questions on North American large caps. There's so many ways to get a hold of us. There's no excuse not to get in touch. Give us a call at 1-855-326-6266. You can send us an email. You can tweet myself or Market Call. And of course, those video questions get you right to the front of the line. And there too, you can send it via Twitter, via Facebook, or good old-fashioned email. Just keep it 30 seconds or less. And of course, you get to the front of the line. But right now, David Burrows is at the front of the line. Thanks so much for joining us, David.
Great to be here.
So we're looking at these markets. We've hit this benchmark of getting an all-time high. And I think today, Bank of America came out with this fund managers survey that fund managers are at the highest level of cash position in something like 10 years. So not a lot of money being put to work in these markets. How do you think about that? How much cash are you guys sitting on?
I think it's incredibly bullish. So we had a number of interviews in February and March where we expressed a view that we have just gone through the first significant correction of a new bull market that started in 2013 when the S&P exceeded its all-time high. So corrections come in price or they come in time. We went through a time correction. And if you think about it, the U.S. market has really chopped its way sideways since 2000. And so there have been lots of people who have become very skeptical, nervous, bearish. And a new bull market is always born out of skepticism and difficult environment. So now we've made a new high. There's all kinds of money that's trapped on the sidelines. And that is going to have to find its way back into the market. Not to mention the fact that, $200 billion came out of equity mutual funds in the last 2 years and chased things like bonds at 1,000-year lows in interest rates. So we've been fully invested since the second week of February. I think that markets look exceedingly good, and I think people will be very surprised with the next 2 years as the U.S. economy slowly recovers.
Let's flesh that out. You said a correction comes in time or price. I think we're more familiar with the price correction. Right. What do you mean by time?
Well, markets go through a period where they lift, like they did from the beginning of 2013 in the U.S. until early 2015. Canada topped out September 2014. And then either you become accustomed to things like 2008 or 2001 through 3, where you get a significant long-term decline. But sometimes markets just correct by trading sideways over time, and investors die of boredom and frustration. And it's true. And people finally just say, oh, I'm out. I've had enough. And that is what sets up, ultimately, when you make a new high, people had lots of chance to sell. And realistically, given the world we've been through, people have been given all kinds of time to consider all the possible things that could derail the market. There's nothing really out there that people aren't considering. Yet despite that, we've got a market that sucked up Brexit in about 3 days.
Yeah.
That tells you something about the underpinnings of the market. And here we are at new all-time highs, and I can't tell you how many people want to say, yeah, but. What about this? Yeah, but what about that? And realistically, it's hard for a technician, for instance, someone who looks at charts, to now make the case that this is a big top in the market. They have to come back on board. Mutual funds have high cash positions. Hedge funds have been very underlevered over the last period of time. Pension funds actually need to rebalance fixed income back to equities. And realistically, the equity asset class is the only asset class that has not really been revalued as rates went lower. So look, the earnings yield on the S&P 500 is about 6%, yield on a 10-year bond below 1.5%. The difference between the two is the risk premium you're paid to make investment. We're supposed to make investment, we get paid to take risk. And that risk premium is as good as it's been in many, many years.
Yeah, but let me be the one, because all the things you just mentioned, sure, there are headwinds, but there's money on the sideline that has to be put to work. That doesn't seem like a fundamentally supportive factor. So from a fundamental perspective, what is it to justify the market at an all-time high?
So as I was saying, you have a choice. You can put your money in fixed income at 1.5%. You could buy a corporation whose earnings yield, or the return on their capital, is X, which is average company in the S&P is about 6%. If you looked at the return of capital to a shareholder, dividend plus share buybacks, it's about 5.5%. You can easily build a portfolio today with a 10% return back to the shareholder. So you can put your money in at 1.5%, and that is fixed income. Or you could buy an earnings stream that's generating a return that is significantly better than that. And as I say, the difference between the 10-year and the earnings yield is as wide as it's been in many, many years. That's without assuming earnings growth, and certainly you can build an earnings growth portfolio. It's without dividend growth. It's without share appreciation. So, many years ago, pension funds recognized that buildings were long life assets, and they had a much higher yield than you can get in bonds, so they started buying buildings. And that excess risk premium got squeezed out over time. Equities are most likely the place that money goes next for that reason.
The new buildings. All right. David Burrows will be with us for the next hour. President and Chief Investment Strategist at Barometer Capital Management. Give us a call if you have any questions on North American large caps. We'd be happy to answer them. 1-855-326-6266. We'll be right back.